There are always two sides to a coin, so you can't just look at one side and make a final conclusion on whether the situation is good for you or not. So that's the same situation when it comes to investing. You can always look at the certain investment and you can say, well, this is bad or this is good. You have to look at both sides and then make a final decision once you get two perspectives. So that's why today I'm going to talk about Dividend 15 split Corp again, because yesterday I made a video on why you should avoid this. So I made a 3 reason why you should avoid it. So today I'm going to give you a 3 compelling reason why you should buy this fund. So before you go to those 3 reasons, if it's your first time watching this channel, just make sure you subscribe so you don't miss any update on this type of funds, because I always bring this type of investment and funds update. First reason you should buy this fund will be price and valuation. So look at the Dividend 15 split Corp right now. Today actually went up. It went all the way to 3% and it came down, but eventually it closed at $4.01. So yesterday it closed at 3.96. So today was up massively. We look at the 52-week range is 52. It was at $8. It came down all the way down to 3.83. So let's say, for example, you buy today at $4, it goes up to $8. That's 100%. When I look at that, it's a really compelling reason to buy that. And has it done in the past? Yes, in the past it has gone down a little bit, and then of course it recovered. And because of that past that it went down and recovered at the time when it went down massively, like here and here, so we can see the pattern that it always recover from that point where it goes when it crashes badly. And when we look at valuation here, I think I made a video a couple of days ago tell evaluation. Right now we look at the NAV pre-distribution is a 1485. So when we look at this NAV minus, we did calculation that you take what you're doing here with this NAV, you're gonna take $14 minus 10 1485 minus $10, right? So we will take 14.85 minus $10. So we have 485. If you take 485, you take the price of the share today, so $4. You divide that by 4.85 minus 1 equal to 17. So right now you're getting discount on 17% of this fund. Times 100, you see there, 17%, 17.5, so almost 18% discount on this fund. So even if you buy today and then they say it doesn't pay any dividends for a couple more months, you have bought the fund, which is very cheap. So that's one of the reason. We go into reason number 2. It's distribution history. So you're buying this for dividends. Right now it pays about over 30% in dividends, right? So it's about 31%. So even if, let's say for example, the stock you buy at that $4 and the stock does not recover, it stays at $4, right? And then it stays just like that. It doesn't go up. You getting 30%. That's a bigger return. You going to outpace, actually even Warren Buffett doesn't get that 30% annually. So that's a big, you're getting that money, a return on your money. That's a really huge. But we can ask a question, is it guaranteed though? So to answer that question, we're just going to look at the history of this fund. As I've said before, this fund has been paying dividends since, look here, from 2004 he's been paying dividend, and he has paid all the time. He did miss in 2008. Actually no, he did not miss in 2008 when there was a market crash. So the only time he missed was actually 2020 COVID crash. At that time he missed for about from March 2020. We go here, back here, you can see March 2020. So 1 month, 3 months they didn't pay, and then they reinstate after 3 months. And they also did not pay in October. So for the period of this fund, it has only missed very few times, very, very few times, less than 10, out of like many, many years, over 20 years, right? So that's a pretty good history. So because of that, even though they've missed two times, in August 2023 and September 2023, because of their past history of paying those dividends and restating that, we can assume that they will restate this time, and you're getting juicy over 30%. That's reason number two. Reason number three will be core holding. The fund itself is investing in, because of course they buy these 15 stocks right here, and then they're going to write calls option with some leverage to generate that cash dividend or distribution they're giving to you. So, but when we look at the core holding that they're investing, that they're holding, how the fund invest in, they're pretty solid companies, right? So we look at the Bank of Montreal, Bank of Nova Scotia, BCE, CI Financial, CIBC, Enbridge, Manulife Financial, National Bank of Canada, Royal Bank, Sun Life Financial, Telus Corporation, Thomson Reuters, Toronto Dominion Bank, TransAlta Corporation, TC Energy. So we got our energy companies, we got telecommunication companies, we got some media companies, right? BCE, it's a media company, those Thomson Reuters media company, and we have mostly banks and financial. These are one of the bluest of bluer chip in Canadian financial industry. So because of those three compelling reasons I've mentioned, right? Reason number one would be a price and valuation right now is very cheap. We look at the reason number two is distribution history. They have a great record of distributing and reinstating those dividends whenever they cut. So the reason number three would be our underlying stocks that the fund invests in. So that's pretty much it. I just want to give you update and give you another perspective on why you should invest in Quadravest. And again, if it's your first time, just make sure to subscribe. And if if you like my content, give me a like. Thank you very much for watching. Till we meet again on next video. Bye bye.